August 17, 1998. Moscow, the Russian government defaults on $40 billion of domestic debt. GKO treasury bills that promised 135% interest rates become worthless paper. The ruble, pegged at 6 to the dollar, collapses to 21 within 2 weeks. That is a 2/3 loss of value in 14 days. Banks freeze. The payment system stops. ATMs run dry. Life savings evaporate. But here is the absurd part. This was entirely predictable. The IMF warned. Economists warned. George Soros publicly declared devaluation inevitable just 4 days before the crash. Everyone knew it was coming, yet when the default arrived, it still destroyed the Russian middle class overnight. Over the next 3 months, inflation hits 84%, banks collapse, unemployment jumps to 12%, GDP contracts 5.3% in 1998 alone. The Soviet Union collapsed in 1991. 7 years later, Russia's attempt at capitalism implodes even faster than communism did. But here is what makes this different. Russia did not run out of money. They printed too much of it. They borrowed in rubles to finance deficits, paid 135% interest to attract investors, then defaulted anyway. This was not a liquidity crisis. This was a Ponzi scheme run by a government. How did Russia destroy its own currency in just 7 years of capitalism? And why are we watching the exact same pattern unfold right now with the ruble collapsing again under sanctions? This is the story of Russia's 1998 crisis. By the end, you will understand the 7 steps that destroy emerging market currencies. See how fiscal deficits turn into sovereign defaults, and recognize the warning signs flashing in Russia today. This is not just history, this is a warning. It is 1991, the Soviet Union collapses. Russia emerges as an independent nation for the first time in 70 years. Walk through Moscow and you see a city in transition. Old Soviet banners come down, Western brands appear, McDonald's opens, the smell of opportunity mixes with uncertainty. In this world, everything must be rebuilt from scratch. The communist economy operated without money, prices were set by planners, production was commanded, trade was controlled. Now Russia must create capitalism overnight. Stock markets, banks, private property, foreign investment. None of this infrastructure exists. To most Russians, this transition promises prosperity. The propaganda says capitalism means wealth, democracy means freedom, the West will help, investment will flow, living standards will rise. Trust the process. But beneath the surface, the foundation is rotten. Russia inherits the Soviet Union's debts, its factories, its bureaucracy, its corruption. Privatization becomes theft. State assets are sold to insiders for pennies. The oligarchs are born. 7 men control 50% of the economy within 5 years. This is not capitalism, this is looting. Meet Yegor Gaida. He is Russia's acting prime minister in 1992. He believes in shock therapy, free prices immediately, privatize state companies, open to trade, transform the economy in months, not years. He unleashes hyperinflation. Prices rise 2,500% in 1992. Life savings become worthless. Pensions cannot buy bread. The middle class is destroyed in the first year of capitalism. Then there is Anatoly Chubais. He leads privatization from 1991 to 1996. He gives every Russian a voucher worth 10,000 rubles. You can use it to buy shares in privatized companies. It sounds democratic. In reality, most people sell their vouchers for vodka money. The oligarchs buy them cheap and acquire state assets for nothing. The greatest wealth transfer in history happens in plain sight, and there is Viktor Yushchenko. He becomes central bank chairman in 1992. He is called the world's worst central banker by Jeffrey Sachs. Why? Because he prints money to fund government deficits, lends to bankrupt state enterprises, finances budget holes with new rubles. Inflation explodes. The currency collapses. He does this deliberately to preserve Soviet-era relationships and power structures. What none of them know yet is that they are building a Ponzi scheme that will collapse in 1998. The pattern is already forming. 1995. Russia finally stabilizes, sort of. The government creates a stabilization fund with IMF help. They peg the ruble in a trading corridor. 4,300 to 4,900 rubles per dollar. They promise to defend this rate. Inflation falls from 130% in 1995 to 22% in 1996 to 11% in 1997. This seems like success. But the peg creates a trap. To maintain the exchange rate, Russia must have foreign currency reserves. They do not. Reserves are only $6 billion in 1998. That is nothing for an economy this size. To defend the peg without reserves, the government needs to balance its budget. No deficits, no printing. They cannot do this either, so they innovate. In 1993, Russia starts issuing GKO bonds, short-term treasury bills, 3 months, 6 months, 12 months, denominated in rubles, paying high interest rates, initially 20 to 30%. This is genius, or so it seems. Instead of printing rubles to finance deficits, borrow rubles from investors, pay them back with new borrowing. This is sustainable as long as investors keep buying new GKOs. Foreign investors love it. In early 1997, Russia relaxes restrictions on foreign portfolio investment. Money floods in. Foreigners buy 30% of all GKOs by mid-1998. They earn 27 to 54% interest rates. This is incredible. Russian bonds pay 50% while US Treasuries pay 6%. The carry trade is irresistible. But there is a problem. The government deficit keeps growing. In 1995, the fiscal deficit is supposed to be 3% of GDP. It actually runs higher when you count interest payments. By 1998, interest payments consume 50% of the budget. Half the federal budget goes to paying interest on previous borrowing. This is the definition of a Ponzi scheme. At first it seems to work. Early investors make money, tell their friends. More money flows in. GCO auctions are oversubscribed. The government borrows more. By 1997, the stock of GKOs grows from 10% of public debt in 1995 to 27%. This is $40 billion of short-term debt that must be rolled over constantly, and prices accelerate upward. In May 1998, GKO yields double from 27.8% to 54.8%. Something is wrong. Investors are demanding higher rates. They see risk. Then in July, yields hit 70%. Sberbank, the state-owned savings bank, refuses to roll over its GKO holdings. If the state bank will not lend to the state, who will? By August, GKO rates reach 135%. That is the peak. Nobody knows it yet. Meanwhile, Russian banks discover a profitable game. They borrow dollars from Western banks, use the dollars as collateral to borrow rubles from Russian banks, buy GKOs with the rubles, earn 50 to 135% interest, cover the dollar borrowing cost, pocket the spread. This works beautifully as long as the ruble stays pegged and GKOs keep paying. But the banks add leverage. They sell forward contracts promising to deliver dollars at 6 rubles per dollar. Foreign investors buy GKOs and hedge their currency risk with these forwards. The notional value of outstanding forward contracts reaches $40 to $50 billion. The banks have promised to deliver dollars they do not have. Then comes July 1997. Thailand's currency collapses. The Asian financial crisis begins. Within months, Indonesia, South Korea, and Malaysia face currency crashes. Investors flee emerging markets. Capital flows reverse. In November 1997, speculators attack the ruble. The central bank defends the peg, burns $6 billion in reserves defending a currency worth 6 rubles to the dollar. They have only 6 billion total. This cannot last. By May 1998, foreign investors start liquidating GKO holdings. The market freezes. Half the stock of GKOs is held by foreigners. When they sell, nobody is buying. Yields spike to 54%. The government cannot afford to roll over debt at these rates. In June 1998, the government runs out of money to make bond payments. The central bank intervenes, buys GKOs to keep the market functioning. But this means printing money to finance the deficit, the very thing the stabilization was supposed to prevent. The peg is doomed. The IMF tries to rescue Russia. In July, they approve a $22.6 billion aid package. $4.8 billion in immediate cash. This is supposed to calm markets, allow Russia to make payments, defend the ruble. It fails immediately. Investors take the IMF money and run. Western banks liquidate GKO positions. Capital flight accelerates. Then on August 13th, George Soros publishes a letter in the Financial Times. He writes that devaluation is inevitable. The ruble crashes. The final panic begins. August 17, 1998. The Russian government holds an emergency meeting. Prime Minister Sergei Kirienko makes 3 announcements. First, the ruble corridor is widened from 5.25 to 7.15 rubles per dollar to 6.00 to 9.50. This is a 25% devaluation. Second, GKO bonds are frozen, restructured. defaulted on $40 billion of domestic debt is wiped out. Third, a 90-day moratorium on external debt payments. Banks cannot pay foreign creditors. This is complete financial collapse. At first, people think it is temporary. Just a currency adjustment, a debt restructuring. Things will stabilize. But then the cascades begin. Within 24 hours, the ruble falls past the new 9.50 ceiling. The central bank abandons the peg entirely on September 2nd. The ruble floats freely. It collapses to 21 per dollar by September 21st, from 6 to 21 in 5 weeks. The Moscow stock market had already fallen 75% from its 1997 peak of over 500 on the RTS index. Now it craters further. Trading is suspended for 35 minutes due to sharp falls. When it reopens, nobody wants to buy. Foreign investors who lost 70% want out. Russians who saved in stocks watch fortunes evaporate. Then the banking system implodes. Most Russian banks hold large amounts of When the government defaults, the banks become insolvent overnight. The GKOs on their balance sheets are worthless. Incomebank fails. One Exim Bank fails. Tokobank fails. These are 3 of the 6 largest banks in Russia. They hold deposits from millions of Russians. Vladimir Putin runs Uneximbank. When it fails, he moves valuable assets to a small unknown bank called Rosbank, leaves Uneximbank to collapse. This is called bridge banking. Strip the value. Let the shell fail. Depositors lose everything. This happens across the system. The payment system freezes. Banks stop processing transactions. People cannot access their money. Merchants cannot accept payments. Commercial activity halts. The interbank market dries up. Banks refuse to lend to each other. Nobody trusts anyone's balance sheet. Meet Ivan Petrov. He is a middle-class Muscovite. He saved 100,000 rubles over 10 years. At 6 to the dollar, that is $16,666. Comfortable savings. On August 17th, his bank freezes his account. When he finally gets access months later, the ruble has collapsed. His 100,000 rubles are now worth $4,760. He lost 70% of his savings. His apartment rent, which was affordable, now consumes his entire salary. He cannot afford food. He watches his family's standard of living collapse. Meet Elena Sorokina. She kept her savings in Sberbank, the state bank, supposedly safe. She has 200,000 rubles. After the crisis, Sberbank forcibly converts dollar deposits to rubles at the old 6.0 rate. Then the ruble devalues to 21. Her dollars become rubles worth 1/3. Then inflation eats another quarter of the value. She loses 75% in total. She worked 20 years to save that money. It is gone in 3 months. But some people escape. The oligarchs, they saw it coming. They held dollars offshore. When the ruble collapsed, their wealth actually increased, in ruble terms. They buy assets from desperate sellers for pennies. Real estate, companies, factories. The crisis concentrates wealth further into the hands of those who already have it. Gashenko, the central bank chairman, receives IMF money to bail out banks. The money disappears to offshore havens immediately. Bank owners let their institutions fail. The bailout money vanishes. Nobody is held accountable. This is Russia. By September, imports fall 50% in 4 months. Russians cannot afford foreign goods anymore. The ruble is worthless internationally. Inflation hits 84% annualized. Prices double. Then double again. Pensioners survive on 1,000 rubles per month. That is $47. Poverty explodes. The government collapses. Yeltsin fires Kirienko on August 23rd, 6 days after the default. He appoints Yevgeny Primakov as prime minister. Primakov is the 5th prime minister in 12 months. Political instability matches economic chaos. Within a year, Vladimir Putin becomes prime minister, the 6th in 18 months. The crisis spreads internationally. Russia's default is the largest in history at the time. It triggers the collapse of long-term capital management in the United States. LTCM is a hedge fund with $4.6 billion in capital, controlling $125 billion in assets. They bet heavily on Russian bonds converging with Western bonds. When Russia defaults, LTCM faces collapse. The Fed organizes a $3.6 billion bailout. Global markets panic. The contagion is real. So what really happened? History books say Russia's 1998 crisis was caused by falling oil prices and the Asian financial crisis. External shocks, bad luck, but that is not just incomplete, it is dangerously wrong. Here is what actually happened. Russia's crisis was caused by fiscal deficits financed through a Ponzi scheme of ever higher interest rates on short-term debt. When oil prices fell and the Asian crisis hit, the scheme collapsed. But the scheme was unsustainable regardless. External shocks just determined the timing. Let me break this down. Russia ran chronic fiscal deficits from 1992 to 1998. Instead of cutting spending or raising taxes, they borrowed, first by printing money, causing hyperinflation, then by issuing GKOs, short-term bonds at high interest rates. By 1998, 50% of the budget went to interest payments. That left 50% for everything else: defense, pensions, salaries, police, everything. Think of it like this. Imagine you earn $50,000 per year. But here is what nobody talks about. The people who profited. Foreign investors who bought GKOs in 1996 and sold in early 1998 made fortunes. They earned 50 to 100% returns. Got out before the crash. The oligarchs who held dollars offshore and bought ruined assets after the crash became wealthier. The insiders who knew the default was coming and positioned accordingly. They won. The system was designed to transfer wealth from ordinary Russians holding rubles to sophisticated investors holding dollars, from savers to speculators, from the middle class to the oligarchs. This was not accident. This was extraction. Now let me show you the pattern. This is the emerging market crisis formula. It happens every time. First, stabilization with a peg. Fix the exchange rate to stop inflation. Looks successful initially. Creates confidence. Second, fiscal deficits persist. Government cannot balance the budget. Borrows in local currency at high rates. Third, foreign capital inflows. High interest rates attract foreign investors. Money floods in. Asset prices rise. Fourth, Ponzi dynamics emerge. Interest costs grow. Government borrows more to pay interest on old debt. Debt spiral accelerates. Fifth, external shock triggers doubt. Oil prices fall. Regional crisis hits. Investors question sustainability. Sixth, capital flight begins. Foreign investors sell, try to convert local currency to dollars. Reserves drain. Seventh, default and devaluation. Government cannot pay debts or defend currency. Defaults, devalues, crisis explodes. This pattern repeated in Mexico 1994. Thailand 1997. Indonesia Keseribus 1998. Argentina 2001. Turkey repeatedly. The mechanism is universal. Now let us talk about 2024 and 2025. Right now Russia faces a different crisis, not from borrowing, from war. In February 2022, Russia invaded Ukraine. Western nations imposed the largest sanctions in history, over $300 billion in central bank reserves frozen. Russian banks cut from SWIFT. Oil exports capped at $60 per barrel. The ruble should have collapsed immediately, but it did not. At first, Russia imposed capital controls, forced exporters to convert foreign currency to rubles, raised interest rates to 20%. The ruble actually strengthened in 2022. This confused everyone. How can a sanctioned country have a strong currency? The answer is government intervention. Russia manipulated the ruble higher to show sanctions failed. It worked temporarily, but now the facade is cracking. In November 2024, the ruble fell 10% in 2 days, down 20% since September, down 25% from summer highs. The ruble trades at 100 per dollar in late 2024, weakening to over 110 by early 2025, before somewhat recovering. Sound familiar? Let us run through the checklist. Fiscal deficits. Check. Russia's federal budget deficit hit 3.5 trillion rubles in 2024. External shock. Check. Western sanctions, block access to SWIFT, freeze central bank reserves, cap oil prices. These are the 2024 equivalent of 1998's oil price collapse and Asian crisis. Capital flight. Check. Foreign companies left Russia. Western investors sold Russian assets. Russians with money moved it offshore. Capital is trapped by controls, not by choice. Ponzi dynamics. Check. Russia borrowed $10.5 billion to defend the ruble in July 1998. Now they spend reserves on the war, burn through the National Wealth Fund, finance deficits through domestic borrowing and money printing. Currency pressure. Check. The ruble lost over 50% of its value against the dollar and euro by late 2024. The central bank cannot defend it because reserves are frozen. They raised interest rates to 21% in late 2024, the highest in 25 years. This crashes the economy while failing to stabilize the currency. Now, is this exactly like 1998? No. Russia has oil revenue 1998 lacked. They export to China and India instead of Europe. They have fiscal space 1998 did not. GDP grew 4% in 2023 and 2024 from war spending. But 2025 growth is projected at only 1% or lower. The boom is ending. What is different? Russia learned from 1998. They built reserves, paid down external debt, ran budget surpluses from 2000 to 2020. Putin used oil wealth wisely for 20 years, but now the war is consuming everything. Defense spending doubled. Oil revenue fell 40% from 2022 to 2023. The budget deficit is widening. Sanctions are tightening. The fundamental dynamics are similar. Unsustainable fiscal path, currency under pressure, central bank losing control, foreign capital locked out. The question is timeline. 1998 collapsed in weeks. 2025 might collapse over years, or might not collapse if the war ends and sanctions lift. What should you watch for? First, the ruble exchange rate. If it breaks 120 or 150 per dollar, panic will spread. Ordinary Russians will rush to convert rubles to dollars. That triggers the death spiral. Second, inflation. Currently 8.78% in late 2024. If it reaches 15 or 20%, wage price spirals begin. The central bank loses credibility. Even 21% interest rates cannot stop it. Third, oil prices. If Brent crude falls below $60 per barrel as World Bank projects for 2026, Russian budget revenues collapse, deficits explode, crisis accelerates. Fourth, reserve depletion. The National Wealth Fund had over $180 billion before the war. Now it finances deficits. If it drains to zero, Russia cannot defend the ruble or finance spending. Default becomes inevitable. I am not predicting Russia will default in 2025. I am showing you the pattern. The pattern from 1998. Fiscal deficits, currency pressure, external shocks, Ponzi dynamics. The question is whether Putin can end the war before the money runs out. So why do we keep falling for this? Because emerging market crises are not accidents. They are features of pegged exchange rates combined with fiscal profligacy. We are wired to trust government promises. Russia promised to defend 6 rubles per dollar. Investors believed them, until they could not. Governments are wired to borrow instead of cut spending. Raising taxes loses elections. Cutting pensions causes riots. Borrowing delays the pain. Lets the next administration handle the crisis. This is politically rational, economically suicidal. Investors are wired to chase yield. GKOs paid 135%. US Treasuries paid 6%. The spread was irresistible. Even knowing the risk, investors could not resist. They thought they would exit before the crash. Most were wrong. Central bankers are wired to believe they can manage the impossible, defend a fixed exchange rate without reserves, sterilize capital inflows without inflation, finance deficits without monetization. Gashenko tried, failed. Modern Russian central bankers are trying again. With frozen reserves and a war economy, their task is even harder. But here is what this story really teaches us. The disaster is not the default. The disaster is the 7 years before the default, when everyone pretends it is sustainable, when oligarchs loot, when the middle class is destroyed, when corruption becomes the system. By the time the crisis hits, the damage is already done. Russia in 1998 was a kleptocracy disguised as capitalism. The default just revealed what everyone already knew but refused to acknowledge. The system was broken from the beginning. The crisis was inevitable. The only question was when. Russia in 2025 is an autocracy at war. The economy is militarized. The population is controlled. The ruble is manipulated. But underneath, the same dynamics are building. Unsustainable deficits, currency pressure, reserve depletion, external shocks. Every generation thinks their crisis is different, better managed, more sophisticated, more resilient. Russia thought the 1998 crisis was behind them. 26 years of growth proved they learned. But now the same patterns are forming, not identical, but similar enough to worry. The question is whether Russia will repeat 1998, default, devalue, destroy the middle class, or whether they learned enough to prevent it. The answer depends on the war. If it ends, sanctions might lift, oil revenue might recover, the crisis might be avoided. But if the war continues, mathematics takes over. You cannot spend 8% of GDP on defense while oil revenue falls and sanctions tighten. The budget cannot balance. The deficits will grow. The currency will fall. Eventually something breaks. Understanding this does not give you a crystal ball. 1998 seemed impossible until it happened. Then it seemed inevitable. The same will be true of whatever happens next. We will see it coming. and be surprised when it arrives. But pattern recognition is priceless. When you see fiscal deficits financed by high-interest borrowing, you are seeing 1998. When you see exchange rates defended by controls instead of reserves, you are seeing 1998. When you see external shocks hitting fragile economies, you are seeing 1998. The outcome is predictable, even if the timing is not. You cannot control Russian fiscal policy. You cannot end the Ukraine war. You cannot lift sanctions. But you can recognize when a government is spending beyond its means, when a currency is held up by interventions instead of fundamentals, when a crisis is building beneath the surface. The Russians who survived 1998 were not the ones who trusted the government. They were the ones who held dollars, who owned real assets, who understood that paper rubles could become worthless overnight. The same will be true of whoever survives the next crisis. That lesson is 26 years old. It is timeless. Now I want to hear from you. Do you see the 1998 pattern in Russia's 2025 economy? Will sanctions and war force another default and devaluation? What am I missing? Drop your thoughts in the comments. The best analysis often comes from you, not me. If this changed how you see emerging market crises and currency collapses, hit that like button. Subscribe if you want more economic history that actually matters. Next time, we are diving into Argentina's serial defaults. 9 defaults since independence. The same country, the same pattern. Every generation, another lesson they do not teach in school. Remember, history does not repeat, but it rhymes. And right now, the Russian ruble is rhyming with 1998. See you in the next one.